Good morning, everyone. It's 10 o'clock, so we're going to get started. Thank you for joining us today. My name is Ashley Brown, and on behalf of KLR and our affiliate companies, I wanted to welcome you to our webinar, 2021 Year-End Tax Planning Highlights for Businesses and Individuals, with Laura Ioannis and Anthony Mangiarelli. So 2021 has had continued uncertainty, and as we approach year-end, we know that you have many questions regarding navigating your year-end tax planning, especially with the potential of the Build Back Better Act on the horizon. Laura and Anthony are here today to discuss year-end tax planning opportunities and provide an update on the Employer Retention Credit and PPP program. We'll be covering the frequently asked questions that you submitted when registering at the end of the presentation. And as a reminder, a link to a recording of today's session will be sent via email this afternoon. Webinar attendees will also be the first to receive a link to download our 2021 year-end tax planning guides for individuals and businesses. So with that, I'm going to turn it over to Laura and Anthony. Good morning, guys.
Good morning.
Good morning. Thank you, Ashley, for that warm introduction, and thank you for all that you do. These webinars would not be possible without your efforts, as well as the efforts of our entire world-class marketing team. To those watching, good morning as well, and please allow me to introduce myself. My name is Anthony Mangiarelli. I'm a partner here at KLR and the director of the Enterprise Solutions Group. And while we have everyone's attention, on behalf of KLR, we'd like to thank our clients for putting their trust in us, our referral sources for their continued confidence, and our team members for their extraordinary efforts these past 20-something months. I'd also be remiss if I did not remind everyone while I have your attention that we're always looking for new opportunities as well as new talented individuals to join our team. So please keep us in mind where possible. And lastly, I'd like to just direct everyone to our website, www.conlitwin.com, where we have voluminous resources, including webinars, blogs, white papers, newsletters, record retention guides, and all that other fun stuff. I want to go back to this slide because I want to stop here and note that I'm humbled to be partners with such talented, amazing individuals, and today is no exception. For those of you who don't know my partner, Laura Ioannis, one word comes to mind, and that's dynamo, and you'll see that in a few minutes what I mean.
You're making me blush.
I tried my hardest. I do want to go through the agenda. We're going to talk about today about the tax legislation update, as well as some tax saving opportunities for 21-22. Laura's going to cover that. And then I'll cover the employee retention credit as well as some PPP forgiveness update. And, lastly, I just want to remind everybody that you got to make good business decisions, and facts and circumstances matter here. And same as last year, it seems, even though I can't believe it's already been a year, 12 months went fast. Uncertainty seems to be the term of the day. And so, Laura, I'm going to challenge you to not say the word maybe and say possibly or perhaps.
And I might throw in a potentially.
Potentially. So with that, Laura, I'll let you go through the tax legislation update.
Thanks, Anthony. And let me just say, it's really my honor to be partners with you. So, you're a great resource for me as well. So thank you. I'm going to throw that back at you. Okay, so, there have been so many tax law changes proposed throughout this whole year, ever since the election of last year. And with all of those changes, all I can say right now is what has been passed and what's being proposed is a bit anticlimactic, because a lot of those changes have been stripped out of the infrastructure bill that passed and out of the Build Back Better Act that is still being bounced around in the Senate. So here's what did pass. The Infrastructure Investment and Jobs Act is a $1.2 trillion bill that was signed into law by President Biden on November 15th. So just a couple of weeks old at this point. There were minimal tax changes included in that bill. Most of the changes had to be stripped out in order to gain that the votes needed for passage. What did remain was the termination of the employee retention credit that was supposed to go through the end of 2021. So there was an early termination of that to end as of September 30th. I'm not going to go into the detail of that because Anthony's going to address that in more detail in his section. But just know that even though the credit has ended as of September 30th, there still is the opportunity to go back and amend 2020 and 2021 payroll tax forms if your business did qualify under the criteria for getting such a credit. And there are a lot of businesses that do qualify that are still, looking at amending those returns to get the credit. The other provision that was included in there that is tax related was revolving around the cryptocurrency. The IRS has really tried to put more of a focus on tracking, managing, getting cryptocurrency transactions to be compliant with the law. This new reporting is basically trying to get brokerage companies to ensure that activity with any cryptocurrency asset is reported to the IRS, just like stock transactions are. And the other thing that came in under this provision was they will start treating transactions, sales of cryptocurrency will be put under the wash sale rules, which stock transactions currently have. And that's if you sell an asset and at a loss, and then within 30 days you repurchase, either 30 days before or after you purchase that same asset, then the loss is disallowed and carried forward to when you eventually sell that position. So really just trying to bring the cryptocurrency phenomenon into a realm where the IRS can monitor it. Personally, I think it's going to be a bit of a nightmare to track administratively. I'm not quite sure how they're going to monitor it and how they're going to bring this into compliance. And I think that's something that the IRS is probably putting their best minds at to try to figure out how to do that. So those are the two things that did stay in the bill. Notable items that were dropped from the original draft of the bill was the increase in a corporate tax rate. That's no longer in there. It's also not part of the Build Back Better Act that is being proposed. Doesn't mean it won't find its way back in, but right now the draft that's out there does not have an increase in corporate tax rates. And also there was a provision in the infrastructure to increase IRS funding to improve enforcement. That was dropped from this bill, but it did sneak its way back into the Build Back Better Act. So that's really the only major tax issues that affect our mainstream clients. There were some Superfund taxes and excise taxes for highway bills, but that really, I'm not going to go into detail on those because I don't think that has much of an interest to our crowd here. So the next piece of legislation, but went too fast, is the Build Back Better Act. Now that was passed by the House. It's a $1.75 trillion bill passed by the House on November 19th. The vote was very close, 220 to 213, but it did pass. It's now sitting with the Senate, and in order for it to pass the Senate, basically all 50 Democratic senators are going to have to be on board to vote for this. And right now, there's no word about where Manchin and Sinema are on these two bills, on this bill. So we're still waiting to see on that. From what I've heard recently, it looks like there may be a vote in the week of December 13th and could be some action before Christmas. Don't know if it's going to pass, but there will be some action likely before Christmas, which means another tax bill passed right before the end of the year makes it very difficult for us to do tax planning. So we're anxiously awaiting that. So some of the provisions that stayed in this draft include, again, clicking too fast, sorry about that, include a return of the corporate AMT. Now, this is only applicable to C Corps, and it's really only going to apply to the very, very high net income corporations. So basically, if the net income reported on the financial statements for the C corporation is in excess of $1 billion, the corporate AMT would come in. So I don't think this is going to have a big impact on our clients, but just keep in mind it's $1 billion for net income. If the company is owned by a foreign parent, then that threshold drops down to 100 million. The other provision that may impact some of our client base here is the income tax surcharge for high income individuals and trusts. So for individuals, basically this is a provision that's targeted at the high ultra net worth clients that have a lot of income. What this surcharge is, it's a 5% additional tax on income, on taxable income that is over $10 million for individuals, at $10 million, 5%. And then if the income goes over 25 million, there's an additional 3% tax. So really it's for that super high income net worth individuals that have high taxable income, 3% at 10 million and an additional, 5% at 10 million, an additional 3% at 25 million. So this isn't going to affect a lot of people, probably the top 0.5% of individuals in the country, but where it may have an impact is with trusts, because that 10 million, 25 million threshold drops down to 200,000 for the extra 5% and 500,000 for the extra 3%. That could impact a lot of trusts. And what that means is, you're going to, trustees, financial advisors, accountants really need to be monitoring. If this does pass, it would be effective starting in 2022. If this does pass, trustees, financial advisors, estate planning attorneys, they're all going to have to really be monitoring where the income level is on those trusts and decide if it makes sense to distribute out that income, more income than normally would be distributed out, in order to get that income down below the threshold where this extra surcharge would start. So there could be, if this does stay in the bill, there will be some more planning needed in the coming years to make sure those trusts, or to try to ensure those trusts stay out of that surcharge threshold. The next one, expansion of the net investment income tax. This was a bit of a surprise. So this is the 3.8% additional surcharge that came into effect with the Affordable Care Act back in 2013, I think. And this was really to pay for Obamacare, to help pay for Obamacare. It was back then the rule, and since then, it has only been effective for, it's been applied to income that, like interest income, dividend income, capital gain income, rental, any type of passive income. This 3.8% was applied to if your adjusted gross income was over 450,000. It's been increased for inflation since then, but basically that 450 threshold. It did not apply to active trades or businesses, income coming through from S corps, from LLCs, if the owner was actively involved in the business. This provision would tax that income. It would tax that pass-through income for S corps and for LLCs would be subject to that additional 3.8% if you were over the $450,000 threshold. So that's a big change. Currently, if somebody sells their business, the assets in their business, the gains on those sales is not subject to that 3.8%. But if you do sell your business and this is in effect, that 3.8% would come in. Anthony, I think you have some thoughts on this as well. Were you a bit surprised to see that provision come in?
Yeah, I mean, it's called net investment income tax, and it's not necessarily investment income if it's your active operations and how you make your living. So it is interesting to see this, and this will impact a lot of individuals that if this slides through, they were not expecting it.
Right, and given that there was no increase in the C Corp tax rates being proposed, this would really create an unfair burden on the small business owners that have pass-through entities. It really starts to, we have to go back to that age-old question, should I convert to being a C Corp? Or if I'm starting a new business, should I really think about C Corp instead of the pass-through regime? So those, if this does stay intact, those are the conversations we're probably going to have again. So we'll see. I have a feeling that's going to be a sticking point with some of the senators, and they're probably hearing from their constituents that that is a very unpopular provision. So we'll see. Personally, I hope that does not make it through in the final bill. So one thing that is a very popular provision is the increase in the state and local tax deduction. So as many of you know, that deduction was capped, as it's an itemized deduction. It was capped at $10,000 per taxpayer back in with the TCJA in 2017. So this provision is proposing to increase the $10,000 cap to $80,000, which sounds like a great increase. It's going to help a lot of people. However, I caution everyone because state and local taxes is still an AMT deduction that gets disallowed for AMT. So I think that even though we may get the benefit of this increased deduction, it may pull people back into an AMT position. So the benefit could be not quite as great as we think it will be, but still a benefit, but it could be possibly not as beneficial as it might appear. Couple of other things, the child tax credit, the higher amount that went into effect for 2021 is going to be extended through 2022. So that was $3,000 per child. If the child was under the age of 6, it's $3,600. And it also, it made permanent, it would make permanent the full refundability of the credit. And what that means is that even if you don't have a tax liability for the year, this credit, you could still get the benefit of this credit as a refundable credit. So that certainly would help. I think this is a popular provision as well because it would help the lower income bracket taxpayers, and it certainly would be a big benefit to those taxpayers whose income is under $400,000, which of course the current administration is trying to make sure that they are taken care of. So that would be extended through the end of 2022. And also included in the draft bill is a lot of green energy incentives as well. Expansion of the tax credits for electric vehicles, expansion of the tax credits related to energy efficient improvements made to your home. So that some of those things would be included as well. So that's really, one other thing that would be in this Build Back Better Act that I don't have listed here, but the qualified small business stock, that's the code section 1202 stock, there is a provision in this draft as well. And basically that would eliminate the benefit of the gain exclusion. Right now there's an exclusion of the gain for this qualified small business stock. If you meet certain criteria, you can exclude up to 75%, possibly even up to 100% of the gain if you meet the certain criteria. If this passes and your income is over $400,000, you would lose that benefit of the exclusion. And it would also be disallowed for any trust or estates that own the stock. So that could be a big, I think to me, that would be a big disincentive if that stayed in. People may not invest in this qualified small business stock, which really is a big help for startup companies, helping those new businesses grow and get the capital that they need. Right now, there's a big incentive to do that because of this code section 1202. But if this bill does pass with that in it, then there could be some disincentive to investors of investing in these types of businesses. Okay. So next up, let's just talk about a couple of year-end tax planning opportunities and a couple of other updates. For individuals, if you don't itemize, and a lot of people don't itemize now because of the higher threshold with the standard deduction, but the individuals not itemizing still have the benefit of a $300 above the line charitable donation. If they do make those donations and don't have enough to itemize, you'll get that $300. The change from 2020 into 2021 is now it would be a $600 deduction for married filing joint. Last year it was limited to $300 for both single and married, but this year it's $300 for single, $600 for married filing joint. The RMDs for your IRAs were reinstated for 2021. As most people know, in 2020, the requirement to take your distribution if you were over age 72 was suspended. So you did not have to take that distribution in 2020, but you do have to in 2021. For those taxpayers that do have to take an RMD, and if they are over the age of 70 and a half, you can consider making your charitable donations directly through your IRA. And if you do that, then you get the full benefit of that deduction, even if you don't itemize. So that's something to consider and something to talk to your tax advisor about whether it makes sense to do. Also, if you haven't taken your RMD yet and you might have some tax withholding shortages because maybe you haven't had enough withheld throughout the year, or your estimated tax payments may have been lower than what they should have been, you can also review that and potentially have your shortage could be withheld from your RMD before you take that distribution. So that's something, if you're still looking at taking the distribution in December, something to look at. Again, if BBBA does pass with the SALT cap, keep your ears and eyes open to see if that passes, because you may have an opportunity before the end of this year to maybe make your next real estate tax payment in December and or make another state income tax payment that may be due on January 15th. You may want to pay it in December if this provision passes to give you that higher threshold with your state and local tax deduction. So that's really on the individual front. For estate and gift, there's really no changes that have been included in the Build Back Better Act. That doesn't mean something can't sneak in between now and the final version that gets voted on, but as of right now, there really are no major changes. The 2020, or even any minor changes. 2021 exemption is at 11.7 million. 2022, it's scheduled to go up to 12.06 million. That's the lifetime exemption. And then your annual gift tax exclusion, where you can gift a person $15,000 in 2021 and not have to report that on a gift tax return. 2022, that $15,000 amount increases to $16,000. So a little bit of a bump there as well. So just keep in mind, even though there has been no change discussed for the lifetime exemption, many states have much lower thresholds than the federal government does. Rhode Island is somewhere in the $1,650,000 range. I believe Massachusetts is about $1 million. So there's still a big need to do some estate tax planning and trying to minimize that burden. So don't think that you're off the hook. You don't, because your exemption's still 12 million, you don't have to do anything. You really should be looking at your state burden as well if that applies to you. Okay, businesses. So whether or not the SALT cap increases or not, there's still a good planning opportunity for businesses. Many states have now implemented a pass-through entity tax for business entities. And what that is for pass-through entities, they can make an election to pay the state income tax on the business income at the business entity level and the deduction would be taken at the business entity level. So the income passing through to the individual owners would be reduced by that deduction. So in essence, it's a bit of an end around and loophole around the SALT cap deduction, but the IRS has already come out about a year and a half ago and confirmed that a business entity tax will be deductible. So they are fully going to allow this tax as a deduction at the business entity level. And for the individuals, the way they get the benefit of that is the tax that is paid at the entity level would flow through to the individuals as a credit to claim on their tax return. So it's basically a way to get that tax deduction that you might not be allowed as an itemized deduction. This Rhode Island has had this tax in effect, and it is elective for 3 years now. Massachusetts has just implemented this tax, and it is effective for 1/1/21. So they have been coming out with draft forms and frequently asked questions about how to implement it. So I do recommend, if you are a business owner with activity in both Rhode Island and Mass, you look at these things and see if it makes sense for your business to make this election. Another thing to be considering, especially in the last 21 months, last 2 years, a lot of businesses have had their employees working from home. And though their homes may be in a state that is not in a state where your business is registered to do business, during the pandemic and during the emergency orders, most states suspended those nexus rules that if they hadn't, and you had an employee working in a state where you were not registered, then you would need to register in those states. Those emergency orders and extensions have all pretty much run out. So as of now, if you do have employees working in other states and your business is not registered there, then you really need to seriously look at that, because the states are looking for those outliers where you may have a presence, and they will try to come after you if you're not registered to do business in those states. So you really need to look at those rules and talk to your accountant about whether or not you're subject to registration in any of those states. Another provision that I want to remind everyone about, this actually went into effect with the CARES Act last year, and basically any business meals that you have, instead of the 50% deduction, you would be allowed a 100% deduction if they are meals that have been had in restaurants. So of course, this was really put into place to help the restaurant industry, to get people out and doing business in those restaurants. It's only effective for 2021 and 2022. So, take advantage of that and know that you do get that 100% deduction. The last thing I just wanted to mention is, and Anthony's going to go into this a little bit deeper on the federal forgiveness side, but for Rhode Island, unfortunately, Rhode Island is one of the very few states in the country that has passed legislation to tax part of the loan forgiveness, the PPP loan forgiveness. And basically, for any forgiveness of a loan that exceeds $250,000, that excess amount will be subject to Rhode Island tax. For 2020, the forms are just coming out. If you had forgiveness in tax year 2020, Rhode Island has been sending out a form for you to complete that basically calculates the excess amount, and you're able to pay that additional tax with that form. And the payment is due by March 31st of 2020. The form is due by December 15th of 2021. Sorry, 2022, the payment is due by, not 2020. So, you got to make sure that the form is completed and that you make the payment by March 31st, 2022. And if you do that, you will not be subject to any late payment penalties or underpayment penalties. I would recommend, I will say that the guidance on how to complete that form is not great. So I would recommend that you talk to your tax advisor and just have them look over the form. It's a one-page form. It appears to be simple enough to prepare it, but there are some what I'll call traps, a couple of traps in there where you may end up not putting the right number on a line, and it may make you pay more tax than you owe. So I do recommend that you run the form by your advisor before you send it in, and make sure that you haven't fallen into any of those traps. Lastly, again, as I mentioned, the employee retention credit, there is still time to amend the 2020 and 2021 returns, so you definitely look at that. And I think this is probably a good segue to you, Anthony, as you're going to take us through those ERC rules.
Yes, thank you, Laura. Great stuff. I feel like we've been beating this quite a bit, this ERC update, into everyone's minds, because you just can't stress how great it is and the magnitude. And literally the last phone call I had before this webinar just discovered that a 30-person client of ours was eligible for 2 quarters, and it's looking to be about a $400,000 credit. So, you know, big flashing lights. We tell everybody ERC, something to consider. And the key is there's a lot of intricacies within the law where you might be eligible under an alternative method as opposed to the more common method. So we encourage everybody to take a look at this that is in the business world. So what is it? It was originally introduced as part of the CARES Act, whereby the credit was 50% on the first $10,000 of eligible wages paid to an employee in 2020. So you could get it up to $5,000 per employee, but the business had to either be subject to a partial shutdown order or a full shutdown order, or their gross receipts had to decline by greater than 50% in a calendar quarter of 2020 when compared to the same quarter in 2019. And you didn't hear about this credit much because if you had received a PPP loan, you were not eligible to obtain this credit. And to be honest, I don't know how many businesses looked at this originally back in 2020 and said, yeah, I'm going to go for this as opposed to the PPP loan, because the PPP loan was so much more advantageous at the time. And I feel as if the government heard that, because in an unexpected move, the Consolidated Appropriations Act earlier this year extended the credit to June 30th of 2021. But the first major item was that it allowed those businesses that obtained PPP loans to also obtain the ERC credit. And additionally, the change in this eligibility was retroactive back to the CARES Act date, so all the way back to March 13th of 2020. What I want to do is I want to separate the employee retention credit into 2 buckets. We've got the 2020 credit and the 2021 credit. So the 2020 credit is from March 13th of 2020 through December 31st, 2020. And the 2021 credit, which was originally extended all the way through December 31st, has recently been ended early as part of the Infrastructure Investment and Jobs Act, so that the 2021 credit is only available for the first 3 quarters of 2021. So January 1st, 21 through September 30th, 21. I can tell you that we have seen hundreds of businesses that we've worked with get these credits, and it's been quite advantageous to the business. So generally speaking, the credit is available to businesses that were forced to have a full or partial shutdown. And you know, it has to be a government order. There has to be a formal government order that shut the business down or shut down a major supplier or a major customer. You know, there's different intricacies you can look into with that, whereby if your business was affected. But we encourage people to look at that. But more importantly, where we see a lot of businesses claiming the credit later on is when their gross revenues declined. And in 2020, as I said, it's a 50% decline in a quarter of 2020 compared to 2019, which is a high threshold to hit. But there are some businesses that have definitely hit that in 2020. Now, why the credit wasn't that popular in 2020 is that in order to look at what wages were eligible, you had to go back to your average full-time employees in 2019. if you had more than 100 average full-time employees in 2019, for the 2020 credit, you were only allowed to get the credit on wages paid to employees who were not working during the shutdown. So you were paying these individuals to stay home. Now, if you had under 100 average full-time employees for 2019, all wages were eligible. So if people were actually coming to work and you were paying them, you were eligible for the credit. But if you were a business that had more than 100 average full-time employees in 2019, this credit was kind of tough for you to get in 2020. And again, as we said, the wages, if you go with the shutdown period, it's wages paid during the shutdown period. If you have the gross receipts decline, this is where it's key. Once you hit the 50% gross receipt decline in a calendar quarter of 2020, you were eligible until the first day of the calendar quarter after your gross receipts were greater than 80% of the same gross receipts in 2019. So, the way to think about that is if you had a 50% decline in Q2 of 2020, and then you had you actually had an increase in gross receipts of Q3 2020 compared to Q3 of 2019, you were eligible until October 1st of 2020. So you got 2 quarters of eligibility in 2020. So it's a little crazy for 2020 how to calculate it. Also to be aware, healthcare costs paid on behalf of employees are technically includable as qualified wages, and wages paid in accordance with the Family First Coronavirus Response Act are ineligible for claiming the credit. Okay. Other item to note, as we said, if you paid the wages using PPP funds, those wages are not eligible for the credit, but we'll discuss that later because there's been some changes there. Additionally, just to let people to know, owner's wages are eligible for the credit, but anybody that's related to the owner, a greater than 50% owner, you're not eligible to claim the credit on their wages. So if you got kids working in the business, you're eligible as the owner and the parent, but the children are not. And how do you receive the credit? This is pretty interesting. At this point now, as Laura said, you have to go back and you have to amend your quarterly 941 payroll tax form. And what's interesting is that we've done hundreds of these analyses, worked with the companies to get the credit. If you've got a good payroll company, what we've seen is that they're electronically filing the amended 941 forms. And when they electronically file the amended form, we're hearing that 6 to 8 weeks is generally when they expect you to receive the refund. And I think that's generous, but 6 to 8 weeks is what we're hearing. There are other ways you can file the amended 941, including paper filing. And from what we're hearing, generally, you're looking at least 6 months for that form to get processed. So this is where if you have a giant payroll company, a good payroll company like an ADP, this is where we would work with them, and that's when you can electronically file the amended return as opposed to doing the paper filing yourself. It's the same thing if you were filing your 1040. You paper file it, you're going to be waiting forever for your refund. Electronically filing it gives you a little quicker way to get that refund. Just some important notes to remember: that government order, it has to be a formal order. You can't have voluntarily shut down and said you were eligible for the credit. If the government is asking for social distancing, that's not technically a shutdown, so that doesn't make you eligible. If you sent all your employees home to work by teleworking, that's technically not a shutdown order, so it doesn't qualify. And most importantly, you got to think reductions in capacity or complete closures. And where we're really stressing this is restaurants. Every restaurant in Rhode Island and Massachusetts from March 13th to March 13, 2020 to at some point in May of 2021 has had some sort of limited capacity and a shutdown order. So you would be eligible under the shutdown order to obtain the credit. And so this way you're not focusing on the gross receipts method, which I would stress, gross receipts is the best way to be able to be eligible for this credit, because numbers don't lie, and shutdown orders, there can be some gray area. But with restaurants, this is really under the shutdown order, you're eligible, and we would encourage you to definitely apply under this. Lastly, not-for-profits are eligible. The one thing I'll tell you is you have to look at gross receipts, and the caveat there is investment income is technically gross receipts for a not-for-profit, but investment income does not include unrealized gains and losses. So a not-for-profit would use their quarterly gross receipts in 2020 to compare to the same quarter of 2019, and just follow that investment income rule where unrealized gains and losses don't count in the calculation. Let you know that unlike PPP, which was the home run where the income was not subject to income taxes and you were allowed to deduct the expenses on your tax return, any credit you obtain through the Employee Retention Tax Credit Program is subject to income taxes. So it is a taxable credit. So that's the credit, the background on it in 2020. And it's still a good credit for 2020, but now I'm going to put the flashing lights up. This is really where we encourage everybody to look. So 2021, the employee retention credit in 2021, here's the changes to the credit. We talked about how in 2020, it was 50% of the first $10,000 in wages paid. In 2021, it's 70% of the first $10,000 of wages paid to an employee per quarter. So in 2020, the most you could get for the whole year was $5,000 per employee under this credit. In 2021, you can get up to $21,000 per employee. You can get up to $7,000 per quarter per employee. And now here's the other flashing light. That quarterly gross receipts drop, because most of the government shutdown orders ended in 2021, but the quarterly gross receipts test is no longer a 50% drop, it's a 20% drop. So what you do is you compare your 2021 calendar quarter to the same calendar quarter in 2019, not 2020, 2019, pre-pandemic. And this is where we're seeing a lot of people trying to do the calculation themselves and falling down. You compare your 2021 calendar quarter to the same calendar quarter in 2019. There is a lesser known exception whereby you can also look at your fourth quarter 2020 calendar quarter and compare it to your fourth quarter 2019 calendar quarter. If there's a greater than 20% drop in your Q4 2020 calendar quarter to 2019, greater than 20% drop, you are automatically eligible for this credit for quarter one 2021. So we've seen a lot of people that didn't have the 50% drop in Q4 2020, that didn't think they were eligible for the ERC, but they maybe had a 30% drop in their gross receipts. Doesn't make you eligible for the 2020 credit, but it makes you eligible for the 2021 credit. So this is a big win. So if you've got 25, 30 employees, you know, it could be $200,000 a calendar quarter if you're eligible. Also important, we talked about that 2019 full-time average, whereby if you had 100 employees, you were only eligible for the credit. They've now increased it to 500 full-time employees in 2019. So this has made a lot of businesses that weren't eligible for the credit in 2020 eligible for the credit in 2021. So if you have under 500 full-time employees in 2019, you should be considering this credit for 2021. The last thing I'll mention with the ERC2 is affiliation rules qualify. So if you had multiple businesses with one owner, and maybe you had a business that wasn't impacted, but one that was completely shut down, and that was your larger business, you have to aggregate revenues. And what we've seen is either through the shutdown order or the gross receipts, the business that was up and running was eligible for the credit and had payroll, whereas the business that was shut down didn't have payroll, so it wouldn't get the credit. So we've seen some where the affiliation rules works in your favor. PPP update. So as we noted earlier, if you paid for your wages with the PPP, you weren't eligible to claim the employee retention credit on those wages. So what happened is that a lot of people filled out their PPP forgiveness forms, and they put all wages on there. They you know, if they had a $100,000 loan, they put $250,000 in wages on there. So there was a question whether or not the wages put on the form, even if you didn't need them to obtain forgiveness, but you listed them on your form, if you listed more wages than required to get forgiveness, were those wages eligible for employee retention credit? And the answer is there's good news on that. Yes. So what we're working with clients on is, as I just used the example, if you had a PPP loan of $150,000, but when you did your forgiveness form earlier this year, let's say you put down $250,000 in wages, the wages above and beyond your PPP loan are technically eligible for the employee retention credit. And further, if you had to hit that 60% minimum for payroll expenses on the PPP, but we've encouraged everybody, if you haven't done your PPP2 form yet for forgiveness, put as much non-payroll expenses as possible if you're eligible for the employee retention credit in 2021, because you can get more of a credit. So, just want to think about the interaction between PPP and ERC. 2020, wages paid from March 13th, 2020 on is when the employee retention credit started. Most people got their PPP1 loan in that early time frame called April. So if you were eligible for the credit, you would be eligible from the March 13th time frame through, let's say you got your loan in April of 2020, you'd be eligible. Let's say we used April 13th in the example, so you'd be eligible for the credit from March 13th through April 12th, 2020. And then let's say you used your PPP loan to pay wages through June 14th. It would be any wages paid after June 14th, 2020 through possibly the end of the year where you'd be eligible for employee retention credit. Keep in mind, 2020, it's just $10,000 in eligible wages in that period of time where you weren't using PPP. 2021, a little different. PPP2 came about probably mid-February. So let's say you're eligible for Q1 2021 for ERC. You'd be eligible for ERC from wages on January 1st, 2021 through, let's say, February 15th, 2021 when you get your loan. And then let's say, you used the PPP to pay wages through April 15th. Let's say you're eligible for second, third quarter of 2021. You could claim ERC from wages paid April 16th, 2021 through September 30th, 2021. So we're seeing a lot of people benefit from this credit. The timing is very important. Remember, if you use the shutdown order, only wages paid during the shutdown order period are eligible for ERC, and a lot of companies had PPP funds then, so we're not seeing as big a benefit. But with the gross receipts test, if you qualify under that method, you're eligible for the whole quarter in 2021, and we're seeing a lot of companies benefit there. And I know somebody's going to challenge me on this. This has happened over and over. Somebody said, okay, well, I got my PPP loan in Q2 2021. I'm only eligible for ERC in the first quarter of 2021. I got my PPP2 loan February 15th. Can I say that I started using my PPP2 loan effective April 1st? And I could tell you, there's nothing in the IRS that says you can't do that. What I can tell you is that the SBA potentially could look at this, and there is that economic necessity certification that you checked off. And I don't know, they could potentially question if you were using ERC, did you need your PPP loan? And then I've had people challenge me and say, okay, well, my loan was under $2 million. The SBA is not going to look at it. The SBA has years to be able to come back and look at your PPP loan. So we're just getting the information out there to people, and we're just educating you that, things could change tomorrow. We've stressed this from the beginning. If you've got any PPP or ERC, anything COVID relief, the thing you need to do is document in a file everything that happened, a memo that talks about why you made a decision to go get a PPP loan. And if you're claiming the ERC, you have to have a file that shows if it was a shutdown order, all the backup, why you qualified under the shutdown order. If it's the gross receipts, a file that shows the breakdown of how you calculated it, because they have years, 3 to 6 years to come back and examine this. And I can tell you in 3 to 6 years, we're going to be on to the next thing in our business and not necessarily focus on why we did what we did years ago. I can tell you with ERC right now, we have a workbook we've prepared in-house. We've worked with hundreds of clients and their payroll companies to obtain the credit. And we've seen credits of, you know, $50,000 for businesses up to $1 million for businesses. So I encourage everybody to look at this and reach out to myself, Mike Garcia, who's on my team, who you've seen on some webinars, Laura, anybody at KLR. We can point you in the right direction and help you on this. And with that, I'm going to wrap up on PPP and ERC, and we're going to go into some questions. So Laura, you want to kick us off on the questions?
Sure. Okay, so these are questions that were submitted by the attendees today. So the first one was, what's your outlook for corporate tax rates and individual tax rates, considering latest political pushback from certain moderate Democrats? Well, what I can say is there was nothing in the infrastructure bill, and there is nothing currently in the Build Back Better Act for increasing those corporate tax rates or the individual tax rates, other than those various billionaire surcharge taxes or millionaire surcharge taxes, and possibly the 3.8%. But the standard tax rates, the 12%, 15%, 25%, all of those rates, they are still subject to staying the same as of right now. So not really looking at any increase in tax rates for the standard tax rates that are in effect right now. The second one, what do you think will happen with the step-up basis rules at death, if anything? Again, that has been taken out of any of the bills that are being proposed. So it looks like the step-up is still in effect unless something sneaks into the Build Back Better Act. But I don't really see that happening. It doesn't seem like there's a lot of desire to or political will to change that rule. So that's probably not happening. What are the rules for 2021 and 2022 regarding the 100% write-off of new equipment? Anthony, I seem to be answering all these questions. You want to take one?
I got the last two.
Okay. Really, there's no change in the 100% bonus depreciation write-off. That still is in effect through the end of 2022. It returns back to, in 2023, it starts to decrease. I believe it's 80%. I'll have to double check on that, but it definitely is 100% for 2021 and 2022. There was a question about anticipated changes to the SALT deduction for 2021. Obviously, we covered that in our presentation, but it does, right now, there could be an increase in that cap from 10,000 to 80,000. How about you take the next one, Anthony? It's PPP Forgiveness.
PPP, I've lived it for the last 2 years of my life. So I've submitted my PPP application for forgiveness in August. When should I expect to hear from the SBA? So the process is you should reach out to your bank, because I would have thought you would have heard something by now. We've worked with tons of companies that have actually gotten audited by the SBA, where they've done kind of like a desk review and asked for additional information. Typically, you hear that within a couple months. So what I would encourage you to do is, if you've submitted your application in August and haven't heard anything, you're not going to hear directly from the SBA. All of the actions are driven through the bank. So reach out to your bank, find out, one, if your bank, because the process is the bank forgives the loan first, and then they submit it to the SBA. So one, you want to find out if your bank has submitted to the SBA. So if they haven't, that means the bank hasn't forgiven the loan first. So if the bank's forgiven the loan, they should have submitted it to the SBA. They can check up on it for you. Next question, is there a way to check with the IRS on the status of the employee retention credit? We submitted a revised 941 back in the spring. They did mention it was mailed on paper. I will say this to people listening. There's this thought that the IRS is a well-staffed, well-functioning operation. And that couldn't be further from the truth. So what I can tell you is, if you want to check on it, you can spend hours on a call line into the IRS, and you may get through, You may not. They hang up after so many hours of you on waiting because you hit your max wait time. And all they will confirm is that they have your application. They will not confirm if it's processed, when you're going to get the credit. As I said, we've talked internally to a lot of the payroll companies. If they've electronically amended the 941, that is your best case scenario. And they're saying 6 to 8 weeks, and that's generous. I think they're probably going to be 3 months out easily on that. And paper filing, we're hearing north of 6 months to get it processed. So next question. Laura, you want to take the first one on the Roth IRA?
Sure. So the question is, does it make sense to convert some or all of our traditional IRA to a Roth IRA this year? You know, my answer to that is always, it depends. If you are of a certain wealth and have the ability to pay the tax associated with that conversion, because when you do the conversion from traditional to a Roth, there usually is a tax impact. And it's a great benefit if you're able to do that and you don't need those resources to fund your retirement to pay and pay the taxes. So really, that's not a yes or no answer. It depends. And what I would recommend is that you talk to your tax advisor and look at the different scenarios of converting partial, all, and what that would look like. Obviously, a Roth IRA is a much better asset to have than a traditional IRA, because the income from the Roth IRA grows tax-free. Distributions from the Roth are tax-free. It's a great estate planning tool. Your beneficiaries would probably much rather inherit a Roth IRA than a traditional IRA, which, you know, the traditional, if your beneficiaries inherit that, they're going to pay tax on that, on those distributions. So it's definitely something worth looking into, but you'd want to model out some various tax projections at different levels. So the next question, should we consider making gifts in 2021 to use some or all of the existing federal estate tax exemption? You know, it's always worth considering and looking at. If I had a crystal ball and knew exactly what was going to happen with the estate tax exemption, I could give you a definitive answer. But as of right now, the higher exemption is still in effect. And I don't know that that will change in 2022, given that it's going to be an election year. But keep in mind that even if the exemption stays intact for several years, it is scheduled to sunset at the end of 2025 and go back down to that $5 million level plus inflation. So it's always a good idea to look at this, at what this might look like, to look to see if it makes sense, talk to your talk to your estate planning attorney and your tax advisor to see if that makes sense.
It's a great question. I actually just did that with a client, married couple. They did a slat whereby one of the spouses put the full 11 million away to memorialize what the deduction is today. So definitely consider. Some PPP proceeds are taxable in Rhode Island, but not in Mass. What if you live in Rhode Island, but your LLC is in Mass? It's all about your apportionment factor. Where are you paying your income taxes based on where you're earning your income or where your assets are? So essentially the PPP taxability in Rhode Island is based upon what your apportionment of taxable income is to Rhode Island.
And that might be a little difficult to determine if it's a disregarded entity because it's reported on a Schedule C, which it's not like the S Corp or partnership return where the form has an apportionment percentage shown on it. So with a disregarded entity, you really need to look at where so that income is being sourced. If you're reporting that as Massachusetts sourced income, all of it, then you really shouldn't have an add back to your Rhode Island income because it was a business source income in Mass.
And keep in mind the first $250,000 of the PPP loan is not taxed in Rhode Island.
Right. The next question, my total portfolio value, which I live off of, is at least 50% unrealized long-term capital gains, no IRA, and I'm 65 years old. Suggestions. I would say that you should be definitely talking to your tax advisor. If your income is low enough, it might make sense to realize some of those long-term capital gains because you could be in a 0% capital gains tax rate for federal purposes. So definitely talk to your advisor and look at what amount you might be able to recognize at a very minimal tax impact. And then the last.
Yeah, what's the latest on the potential changes to the Section 1202 stock? Laura covered that. And what I'll say is where we're seeing is there's a lot of pushback on it because people made decisions based upon the laws as they were. And now they're looking to change it. So we're seeing that there are potential changes on the horizon for 1202, but again, it's possibly going to happen.
Right. So that's all the questions we have. We're now at 11:01, so I apologize for taking you over by 1 minute, but I want to thank all of you who attended. Thanks to our clients, our referral sources, friends to the firm. We really appreciate the support you give to us, and absolutely, I'll echo Anthony's comments that we're always looking to add good people to our team and also add great clients to our team as well. So thank you for those referrals that you have sent, and keep them coming. We love it. We hope this past hour has been informative to you. It was hopefully helpful and you learned a couple things. If you have any follow-up questions, we are happy to help you with that. Reach out to either Anthony or myself or any of your KLR team members. Again, thank you so much for attending and have a wonderful holiday season. Bye.
Thank you both, Laura and Anthony. Just second what Laura said, and if we didn't get to any questions that you had submitted, we're going to try and cover those in a blog, so keep an eye out for that. We are keeping a close eye on all the Build Back Better Act proposed changes, and once anything is finalized, we'll be publishing content on any additional guidance and helping you understand how these changes impact your business as well. And as I mentioned before, all webinar attendees will be the first to receive a link to our follow-up email to our 2021 year-end tax planning guides for both businesses and individuals. So that will be going out in a few hours with a copy of the PowerPoint slides, as well as a recording of the presentation. So as always, please feel free to reach out to us if you have any questions. We're here to help. Thanks again for joining us, and have a great day. Bye-bye.
Bye-bye.
Bye now.